Whether you're living paycheck to paycheck, drowning in debt, or looking for ways to grow your wealth, this video is the first step towards financial liberation. My name is Darius.
And I'm Carmen. Welcome to the Wealth Nation channel, where financial freedom isn't just a dream, but a reality. Now, before we jump into the details of the videos, go ahead and like this video and subscribe to our channel because it significantly helps our channel grow on YouTube. Now, before we get started, I think it's important that we all have the same level of understanding and trying to figure out what is it that we need to do to ensure our financial freedom. So Darius, speak on it.
Point number one is to understand your current financial situation. You have to start getting real with yourself and understand where you are right now financially. How much money do you spend on a monthly basis or weekly basis? How much money do you earn on a bi-weekly, weekly, or however often you get paid? How much money do you earn? And also, how much money do you spend frivolously? You have to start getting real with yourself by understanding these things by using apps and spreadsheets and things of that nature.
Now, if many of you have heard the term "you are what you eat," you should take that same terminology and say "you are what you save." One thing you didn't mention in this list, you're saying how much you spend, how much do you earn, how much do you save? So that should very quickly be able to sum up point number one in you determining what is your financial situation. So you are what you save.
Right.
So let's go back and reevaluate what our savings looks like. And the reason why this is...
Do you even save?
The reason why this is so important is because in a previous video we did, there was a phrase that we said, save early and save often. And it doesn't matter if it's a few $100s here or there. It's just about being consistent and dedicating yourself to savings, because creating a savings plan or a legit savings plan is really what's going to hence save you in the future and give you the financial security and freedom that you need because you planned for it.
Right. So let's put a pin in that savings statement, because that's what we're going to use to invest in a later point that we're going to make. But point number two that we want to make, are you ready?
Yeah, I'm ready. Let's keep
going. Point
going.
number two is we need to create a bulletproof plan, or what some people like to call a budget. I know that's a dirty word for some of us, but what Carmen and I, what we like to call it is a 50-30-20 rule. So the 50-30-20 rule is basically our needs, wants, and savings. Okay. Needs, wants, and savings. 50% of our income goes towards our necessities, 30% of our income goes towards our wants, and 20% of our income goes towards our savings. Now, 50-30-20 rule is something that's been around for a very, very long time, and saving 20% of your income may be intimidating for you if you're living paycheck to paycheck. But the thing to understand is to start. The reason why point number one is so you can identify where you are. And then point number two is allowing yourself to get to that position to where you can start putting aside, let's say 5%. And then let's start every single month increasing it to maybe another percentage on the savings scale. We have to establish where we are first and foremost, and then start working our way to something that's different from where we are currently, because that's how we start the motion of moving forward to the success or financial freedom that we're trying to create for ourselves.
The best part about the 50-30-20 plan is you use those numbers as a baseline, exactly like Darius said, and you move those levers and the numbers how you need to, because you may be not at the 50-30-20 mark, or you may be above the 50-30-20 mark, right? So you can be as aggressive as you need to be in order to accomplish your goals. However, having had a budget and something that we actually use to allocate our income in certain ways, because there's one thing to budget, right? To put everything down on a spreadsheet and then adhere to those numbers. But it's another way to look at your income from a strategic point of view and saying, like, only 50% of my income should go towards my necessities, right? So the things that I absolutely need. 30% should go towards the wants or the optional expenses, and 20% should be saving. So again, instead of just looking at $5,000 every paycheck, we really are able to break up that $5,000 into different buckets to make sure that we aren't overextending ourselves in certain categories. Because like we've talked before in previous videos, where sometimes we over leverage ourselves with our mortgage, we can over leverage ourselves with our cars. This just gives you a snapshot of making sure that you are spending responsibly per the income that you are generating for your household.
Right. And that's a really good point about the mortgage, because if your mortgage is 50% of your income, you are paying way too much for your mortgage. You're basically house broke, because if you think about it, one whole check every single month is just for your mortgage. What are you going to eat? What are you going to put aside for
how you gonna pay your
ABC account?
Yeah.
How are you going to pay insurance on your cars? Do you have a car? You probably living in Brooklyn. Probably living in New York.
These 2 pizzas, your car, public transportation. So anyways, you all get where we're going.
Yeah.
Which leads us to point number 3. And point number 3 is all about eliminating consumer debt.
Right. So according to CNBC, Americans are in $1.1 trillion of credit card debt. And according to Yahoo Finance, 3 out of every 5 Americans are in credit card debt. So eliminating debt isn't just important for you, it's important for about 60% of Americans who are spending their cash flow on high interest debt. Mm-hmm. So we can use our budget to start navigating ourselves away from this high interest debt. What we'll find is that we have cash flow to start putting towards savings. We have cash flow to start putting more money towards our wants. Mm-hmm. We have more money to put towards our necessities and start saving for our ABC account, what we call an ABC account, which is an emergency fund, or your 6 months of savings. We have the ability to establish a good foundation so that we can have good footing for ourselves so that we can start making money.
Now, this goes back to the previous point. We were talking about the 50-30-20 rule, because if you are adhering to the 50-30-20 rule, you will be able to really put the cap on your spending so that it's not just accumulating in your credit card balances. Mm-hmm. And this is, again, the opportunities that we have learned throughout our financial journey of just understanding how to navigate these financial systems and putting pen to paper and putting numbers on the board and saying, we can't go above this, we can't go above that. And not that we were restricting ourselves from, getting out of debt or credit cards and things like that, is we had to recognize what was the goal, right? Because a lot of times we're just spending because we're like nursing an emotion that we're having at the time, right? Something makes us really happy, or we're feeling sad, and now we want to buy something to make us feel better for that immediate gratification. But when you have a bigger goal in mind, all of a sudden getting out of debt becomes a simple fix. All of a sudden adhering to a budget becomes a simple fix when you are really able to understand what is the goal that I want. And at the end of the day, I would assume that the majority of us want some sort of peace of mind. We don't want to have to keep living paycheck to paycheck, regardless of what your income is, right? Because people assume that the people who are middle class and under are living paycheck to paycheck. That's not always the case. We find a lot of our wealthy clients are living paycheck to paycheck because they're over leveraged. Their houses are too expensive. Their cars are too expensive. And next thing you know, you make $1 million a year and you are still living to paycheck. So it's all about really establishing what does your financial health look like and how can you continue to live month after month, breathing a sigh of relief, knowing that everything is paid for and you still have savings in place, you have your investments in place, which we'll get to.
Yeah, making $1 million a year doesn't make you wealthy because you could be in a situation where you're living paycheck to paycheck.
Yeah, and that income creep.
The income creep. Mm-hmm. And the reason why eliminating debt is also important, I think for some people, what happens is they're unaware of it. Mm-hmm. They assume that when they have a credit card, they can make a purchase and they can afford the minimum payment. Yes, you can afford the minimum payment, but what you can't afford is to pay 25% interest when you don't have any investments making more than 25%. That's what we can't afford. So by eliminating the debt, it moves us into our next point, which is to build an ABC fund. An ABC fund is basically that savings. It's basically your emergency fund. What this is going to allow you to do is it's going to allow you to be able to tap into your emergency fund versus going into debt. And just like we said with the 50-30-20 rule, don't just assume that you're going to put $1,000 a month into this account and be done with it. Start putting aside $5 wherever you are right now. Put that aside so you can build your ABC fund, so you can get to a point to where you feel comfortable of moving on to the next thing.
Yeah, that's a good point, because going back to the ABC fund, what we consider your emergency fund these days with inflation and how expensive it is to live these days is for you to have at least $2,000 in a savings account at the bank. And that is something that you do not touch because that is specifically deemed for emergencies, unexpected expenses, things that come up, right? So the assumption isn't just all of a sudden you're just going to drop $2,000 in this account tomorrow. The idea, like Darius said, is to build up to it. So if it's $5, if it's $100, whatever it is, you fill that sucker until it gets to $2,000. And then at that point, you've checked the box and you have your emergency fund saved. Now, it doesn't stop there, because the next account that you need to fund in order to be strategic with this is what we call the stash account, which is 6 months worth of your needs saved. So should you lose a job, should a larger emergency come up, you know that your income will be covered for a minimum of 6 months.
Yeah, now that goes back to how we organize our 50-30-20 rule.
Exactly.
Meaning that you only need 6 months of your needs taken care of. Because if you don't have income coming in, you're not going to be saving money. You're not going to be going out there spending on your wants. You need to make sure that your necessities are taken care of. And if we have identified that early on and we're aware of what our necessities are, it's more easy for us to put aside money for those specific things.
And also what we're doing, what we haven't told you, is we are building up healthy financial habits. Because once you get into the habit of saving for your ABC fund and then you move over to your stash fund, now let's go jump into point number 5, which is talking about investing, right? If you already have those healthy habits built up of knowing how to save, once those 2 accounts are full, the next thing you do is point your savings hose in a different direction and you go, okay, I'm going to turn my savings into a cash flowing asset. And then you allocate those saving funds for your investing purposes so your money can make money for you.
Right.
And you like how I put that transition in there?
I like how you put that in there. And the thing to understand is you cannot skip steps. The reason being, if you go straight to investing your money and something comes up, you have to take your money out of the investment. And what that's going to cost you is not only going to cost you what you had to borrow the money from, but it costs you your future earning potential also. So that $1,000 emergency just cost you maybe $10,000 in the whole scheme of things if that money was still allowed to accrue interest on your behalf.
Now, the other thing to note, like Darius and Carmen, where do you put this money? How do you allocate it? We absolutely recommend that you join us inside the Money School. You can click on the link below because we meet with our members every single month and have live meetings where we talk about how to be strategic with our money. If you're new to the Wealth Nation channel, we talk about life insurance. And so that 6 months worth of income or that stash account, that's going to be living in a whole life insurance policy for us. So there are different nuances in how we work this whole system. And throughout this whole financial health premise that we talk about, it's imperative that you have life insurance because as you're working through all of the steps of being strategic financially, you need to make sure that your loved ones are covered should something happen to you, right? So it doesn't matter if you're saving for the 6 months of savings or if you're in the investing in the accumulation phase. We want to make sure that every step of the way you are covered to ensure, see where I'm going? To ensure that your family is insured. Okay.
Now, when we refer to your investing for the future, we're not talking about what you're able to do with your employer, like your 401k or Roth IRA matches. We're talking about what you're doing separately from those accounts. Those retirement accounts you're putting aside 3, maybe 4% and your company matches that. That's not going to be enough to sustain you for cash flow in the future. What we're talking about is what you're able to do separately, independently from what you're already doing with your employers. Because one thing that it doesn't take into consideration is taxes in the future and inflation. We've all experienced going to the grocery store lately and compared to going to the grocery store maybe 3 years ago, things are more expensive. If you were retiring soon, did you take that in consideration, inflation? No. So let's start thinking about those things right now so that when we get to that point, we can make sure that we're taken care of from a multitude of different areas and avenues and diversified assets. And the only way we can do that is having a solid foundation of doing point number 1, which is making sure we're aware of where we are. Point number 2, make sure we have a bulletproof budget. Point number 3, making sure that we have eliminated high interest debt because that is destroying our ability to generate cash flow. And point number 4, making sure that we have an emergency fund and 6 months of savings. And then finally, making sure that we're investing and not just investing today, but consistently for years to come.
Yeah. And the other thing too, as you were saying this, it just jogged my memory where we talk about, because Darius and I, we started in corporate America, right? And we got amazing benefits. So everything that we talk about on this Wealth Nation channel is about you ensuring your independence. We don't want you to be dependent on the benefits at your corporate job or whatever you're doing right now, right? Because the thing to consider is when we are talking about investments, right? When we left that job,
it can be turned off.
Yeah. And when we left that job, what do we have to do? We had to roll that account over into the next employer's account. Then we had to roll that account over to the next employer's account, right? So you have to think about those things. If you had an established independent fund, and it didn't matter if you're working with Darius or didn't matter if you're working with Carmen, your investments are going to keep working regardless of what it is, and you don't have to worry about the rolling over and what are the penalties and what are the fees and how do I have to do this. And the same thing happens with life insurance, right? When you leave your employer, that life insurance is gone. And what do you have to do? Get more life insurance with the next employer. So these are all of the things that we were talking about of taking ownership, owning your own lifestyle, and why you have to create independent accounts that you can manage and you can facilitate, because nobody is going to care about your money more than you.
Right. So at the end of the day, managing your money is the key to financial freedom. And hopefully we gave you some key information that you may have been aware of, but didn't take into consideration because life happens and we make things more complicated than it should. But simply just make sure you manage your money, because that is the key to your liberation.
Absolutely. Now, if you want to learn more about your financial health, then you can check out the webinar that we recently posted right here.
Remember to own your own lifestyle,
or someone else will.
This video is the first step towards financial liberation.